Did the cancel China plan just backfire in ways almost no one anticipated? What started as a seemingly straightforward initiative aimed at strengthening American manufacturing, protecting jobs, and limiting China's technological influence is now revealing cracks that are difficult to hide. On the surface, the message was simple: reduce dependence on China, bring production back to the U.S., and rebuild national strength. But beneath that simple story lie layers of complexity, hidden pressures, and consequences that are only now becoming visible. Supporters like Scott Bessent made bold claims, stating that 3.7 million American jobs were lost directly due to trade with China. These numbers became widely cited in debates about tariffs, reshoring, and industrial policy. According to this narrative, China's manufacturing boom came at the expense of American workers, turning trade into a threat rather than an opportunity. The public frustration over factories closing, shrinking industries, and declining local employment fueled this narrative. It resonated with policymakers, politicians, and media, and it quickly became the foundation for major policy shifts, including tariffs, investment restrictions, and incentives for reshoring. However, when researchers delved deeper, the story became far more nuanced. Multiple studies, including analyses highlighted by the Savotas Institute, suggested that the real job losses tied directly to China were likely much smaller than claimed. Some estimates indicate that the actual impact may be overstated by 2 to 4 times, meaning the true effect might be closer to 1 million jobs or even less once normal economic shifts are separated from trade-specific effects. This does not erase the struggles in industrial towns, but it does show that the headline figures oversimplify decades of complex economic changes. The decline in U.S. manufacturing has many contributing factors beyond Chinese imports. Automation has replaced many repetitive factory tasks, reshaping the labor market. Companies relocated operations not only to China but also to other countries such as Mexico, Vietnam, and Malaysia. Consumer preferences changed, industries reorganized, and global supply chains became more integrated. When these trends are considered together, it becomes clear that the loss of jobs is a long-term phenomenon influenced by technology, management decisions, and global competition, not merely Chinese trade. Hidden beneath official labor statistics, a quieter story of underemployment and gradual erosion of job quality is unfolding. Companies often lay off workers in small increments or shift employees into contract or part-time roles, keeping headline unemployment rates low while eroding financial security for many households. Workers who lose full-time, skilled positions may take lower-paying service jobs or gig work. These changes maintain the appearance of a strong job market but conceal real economic vulnerability. Understanding these hidden dynamics is crucial to comprehending why the cancel China narrative gained traction despite discrepancies in the underlying data. Policymakers and companies pursuing rapid decoupling from China now face significant operational challenges. Supply chains built over decades cannot be fully shifted without major cost increases. Relocating production, training a domestic workforce, and building new infrastructure require time and capital. Tariffs and restrictions add financial strain, while geopolitical tensions increase uncertainty. Companies are adjusting cautiously, exploring hybrid strategies rather than complete withdrawal. Investors monitor these moves closely, recognizing that partial decoupling can still create systemic risks for markets and industries. Technology sectors are particularly sensitive to these developments. U.S. tech companies rely heavily on Chinese manufacturing, rare earth minerals, and access to the Chinese consumer market. Even minor signals of disruption, such as export restrictions or delays in chip production, can trigger rapid reactions in the stock market. Companies with high exposure to China are especially vulnerable, and their stock performance reflects both real and anticipated risks. Small startups may struggle more than industry giants, as any supply chain disruption magnifies their vulnerabilities. The economic ripple effects extend beyond borders. Disruptions in U.S. China trade impact Europe, Asia, and developing nations. Factories slow down when components are delayed, inflation rises, and global investors track these shifts carefully. Diplomatic and policy actions by either country can trigger a chain reaction, affecting production timelines, consumer costs, and investment flows worldwide. This interconnectedness highlights that decisions made under the Cancel China initiative do not operate in isolation, they reverberate across the global economy. Every aspect of this unfolding story, from hidden job losses and declining employment quality to tech market volatility and international supply chain pressures, illustrates the complexity of decoupling strategies. It also reveals the limits of simplified narratives promoted by policymakers and commentators. While the intention was to restore American strength and independence, the practical realities present a more complicated picture, with consequences that are often unseen by the general public. The Cancel China initiative, while bold and politically appealing, is already facing unexpected challenges. The narrative of millions of lost jobs is being questioned. Hidden employment weaknesses are emerging, and both companies and investors are reevaluating the risks of rapid decoupling. This sets the stage for the subsequent parts, where we will explore in more detail the financial pressures, innovation setbacks, consumer impacts, and geopolitical consequences that continue to unfold. As the Cancel China narrative unfolds, the operational and financial challenges facing American businesses are becoming increasingly evident. Companies attempting to relocate production back to the United States quickly encounter obstacles that were not fully anticipated. Labor shortages, high costs of building or retrofitting factories, and a lack of skilled workers to operate new machinery create immediate bottlenecks. Even when companies secure funding and government incentives, the process of moving complex supply chains involves months, if not years, of planning. The logistical difficulties of sourcing raw materials domestically or from alternative suppliers add additional pressure, creating uncertainty that ripples through production schedules, revenue forecasts, and strategic planning. Workers in affected sectors are feeling the consequences in ways that official statistics often fail to capture. While headline unemployment figures remain relatively low, the reality of underemployment paints a different picture. Employees losing full-time, skilled manufacturing positions often transition into temporary, part-time, or contract work. These jobs frequently pay less, provide fewer benefits, and offer little security. Families who once relied on stable incomes from industrial jobs now face fluctuating paychecks, reduced savings potential, and increased financial stress. Local economies, particularly in regions historically dependent on manufacturing, experience reduced consumer spending, lower tax revenues, and slower community growth. This hidden undercurrent of economic strain complicates the narrative of national resilience and prosperity. At the same time, American technology companies face unprecedented pressures from their dependence on Chinese manufacturing and expertise. These firms rely on China not just for components and assembly, but also for access to a massive consumer market and specialized production knowledge. Disruptions, whether through regulatory restrictions, shipping delays, or export controls, have an immediate impact on innovation timelines, product launches, and profitability. Investors closely monitor these developments, reacting swiftly to perceived risk even before official reports are issued. Stock market volatility intensifies as trading reflects not only current economic realities but also anticipations of future disruptions. Companies that are heavily reliant on Chinese supply chains or markets experience amplified swings, showing the systemic nature of the risks involved. Financial implications are also profound. Companies navigating decoupling face rising costs for raw materials, production, logistics, and workforce training. Scarcity of specialized components, including rare earth minerals and advanced semiconductor chips, drives up prices and slows innovation. Products ranging from consumer electronics to electric vehicles become more expensive and potentially delayed, affecting businesses, educational institutions, and government agencies. These cost increases ultimately reach consumers, demonstrating how macroeconomic and geopolitical policies translate directly into household budgets. The combination of higher expenses, operational delays, and uncertainty about future trade conditions creates a delicate balancing act for business leaders who must protect profitability while adhering to political and policy expectations. Diplomatic tensions compound these challenges. Tariffs, export controls, and reshoring incentives prompt responses from China, including regulatory interventions, export restrictions, and strategic limitations on critical materials. Multinational corporations must adapt rapidly, often implementing hybrid strategies that partially relocate production or diversify suppliers. Despite these mitigations, complete insulation from geopolitical risk is impossible. Companies operate in a complex environment where policy changes in Washington or Beijing can instantly alter market expectations, supply chain efficiency, and financial projections. This dynamic underscores the interplay between economic policy, diplomacy, and business strategy, revealing that actions intended to strengthen domestic capabilities can simultaneously introduce vulnerability. The pressure on investors continues to grow. Analysts scrutinize revenue exposure to China, supply chain dependencies, and the potential for policy-induced disruptions. Rapid stock declines often occur in anticipation of negative developments, reflecting the market's ability to price in perceived risks ahead of official announcements. Companies with substantial Chinese exposure, either through manufacturing or sales, experience the most dramatic volatility. Smaller firms with thinner cash reserves face heightened vulnerability to even minor supply chain interruptions, while larger corporations attempt to balance exposure across global operations. Investor sentiment increasingly influences corporate decision-making, creating a feedback loop where market reactions themselves become a factor in shaping business strategies. Despite the intended goals of the Cancel China initiative, unintended consequences continue to emerge. The push to restore American manufacturing dominance is slowed by high relocation costs, training requirements, infrastructure needs, and delayed production timelines. Companies often find themselves adopting cautious approaches rather than fully committing to decoupling, balancing the desire for strategic independence with the financial realities of operating in a globalized economy. Innovation, too, is affected, as research and development timelines are extended by disruptions in supply chains and international collaboration. Semiconductor production, artificial intelligence projects, renewable energy technologies, and other strategic initiatives rely on the integration of U.S. design and Asian manufacturing expertise, which cannot be easily replaced without significant delays and expense. Consumer access to products is increasingly affected. Supply chain disruptions lead to delays in product availability, higher costs, and fewer choices. Electronics, vehicles, medical equipment, and household goods are particularly sensitive to trade and technological constraints. The cascading effects touch both private consumers and businesses, as delayed shipments, cost inflation, and limited availability create challenges for operational planning, budgeting, and procurement. In this way, the effects of policy decisions ripple far beyond boardrooms, shaping the economic experience of ordinary Americans. Globally, the ripple effects extend to Europe, Asia, and developing economies. Supply chain interruptions, factory slowdowns, and inflationary pressures influence markets worldwide. Investors and multinational corporations must account for these dynamics, as disruptions in one economy often propagate rapidly to others. Policy measures or sudden shifts in trade strategy carry systemic risks, affecting industries ranging from electronics to automotive, energy, and beyond. Understanding these global interconnections is crucial for assessing the true impact of the Cancel China strategy, as no nation or corporation operates in isolation. The cumulative effects of policy, market, labor, and supply chain dynamics create a complex environment where intended benefits are offset by operational, financial, and geopolitical challenges. Hidden layoffs, underemployment, rising costs, supply chain instability, and market volatility reveal the intricate and interconnected pressures of decoupling. Observers must pay attention to multiple layers: labor trends, corporate strategy, investment sentiment, and diplomatic developments to fully understand the unfolding story. The Cancel China narrative, once forceful and seemingly clear, now encounters resistance from both economic realities and growing scrutiny, demonstrating that bold strategies often produce complex and unforeseen outcomes. As the Cancel China strategy continues, the operational, financial, and human challenges facing American businesses and workers become even more pronounced. Companies attempting to relocate production encounter a labyrinth of logistical hurdles, from acquiring specialized equipment to securing skilled labor and retrofitting facilities. Even with government incentives or subsidies, the reality of building complex manufacturing operations on domestic soil takes far longer and costs far more than initially predicted. Training programs struggle to fill gaps in workforce skills, while transportation and supply chain infrastructure frequently lag behind the ambitious timelines set by policymakers. These delays have cascading effects. Production bottlenecks slow product launches, disrupt revenue streams, and force firms to make difficult strategic decisions under uncertainty. The human impact is equally stark. While official unemployment figures remain superficially reassuring, a closer look reveals a hidden layer of underemployment and wage erosion. Workers losing stable manufacturing jobs often transition into temporary, part-time, or gig work, which provides lower income, fewer benefits, and minimal job security. Families that once depended on consistent industrial wages are now exposed to volatile earnings, which can ripple through local economies. Reduced consumer spending, slower local development, and strained public services become the silent consequences of these shifts. Communities that were once economically stable now face uncertainty, eroding the social and economic cohesion that underpinned local prosperity. American technology companies are navigating an equally treacherous environment. Reliance on Chinese manufacturing, advanced components, and access to the vast consumer market creates vulnerabilities that cannot be easily mitigated. Even minor delays in shipping or regulatory changes can cause disruptions in production and financial performance. Investors react to these early signals, often before official policy changes take effect, contributing to volatility in stock markets. Companies with higher exposure to China, whether through production or sales, are disproportionately affected, while smaller firms may face existential risks from even minor supply chain interruptions. The intertwining of policy, corporate strategy, and market sentiment highlights the systemic risks that decoupling introduces. Financial pressures compound operational challenges. Firms face rising costs for raw materials, labor, and logistics, intensified by scarcity of critical components such as rare earth minerals and semiconductor chips. This combination slows innovation, delays product releases, and increases consumer prices. From electronics to vehicles to household appliances, goods that rely on global supply chains are affected directly. For businesses, balancing operational costs against political and strategic mandates becomes a delicate exercise in risk management. Consumers, in turn, absorb these costs, showing how macroeconomic and geopolitical decisions translate into tangible effects on everyday life. Diplomatic tensions further exacerbate these challenges. Tariffs, export restrictions, and incentives for reshoring prompt Chinese countermeasures, including regulatory interventions, supply limitations, and strategic restrictions on key materials. Multinational corporations are forced to adopt hybrid strategies, shifting production partially, diversifying suppliers, or seeking alternative markets. Complete insulation from geopolitical risk is impossible, as policy changes in either Washington or Beijing can instantly affect global operations. This interdependence demonstrates that economic and political decisions are deeply intertwined, with local choices producing international consequences. Investor scrutiny has intensified as companies navigate these uncertainties. Analysts examine revenue exposure in China, reliance on specific suppliers, and potential vulnerabilities to policy changes. Stock market fluctuations often precede official announcements, reflecting investor anticipation of disruption. The sensitivity of markets to geopolitical tension illustrates the feedback loop between policy narratives, corporate performance, and investor behavior. Companies that are heavily exposed to Chinese manufacturing or consumer markets experience the most pronounced volatility, highlighting the interconnected risks embedded in global supply chains. Even within the United States, unintended consequences are mounting. While the initiative aims to restore domestic manufacturing dominance, relocation costs, workforce training, and infrastructure development slow progress. Many companies adopt cautious approaches, balancing the strategic imperative to decouple with practical financial constraints. Innovation suffers as global collaboration is disrupted. Semiconductor development, renewable energy projects, artificial intelligence, and other technology-intensive sectors face delays. The ecosystem that supports rapid technological advancement cannot be easily replaced, and attempts to do so involve high cost and uncertainty. Consumer experiences reflect the systemic strain. Supply chain disruptions lead to delayed product launches, reduced availability, and higher prices for essential goods. Electronics, medical equipment, vehicles, and household products illustrate the cascading consequences of trade and tech policy decisions. Businesses and public institutions, reliant on timely access to these goods, are equally affected, demonstrating that the effects of the Cancel China initiative extend far beyond corporate boardrooms into daily life. Globally, the impact is equally pronounced. Economies in Europe, Asia, and developing nations are affected by factory slowdowns, supply chain interruptions, and inflationary pressures. Investors track these trends carefully, recognizing that disruptions in one major economy ripple across the world. Aggressive policy measures or abrupt shifts in trade strategy carry systemic risks, illustrating that the consequences of the Cancel China narrative are far-reaching, touching multiple sectors and nations simultaneously. The cumulative effects of policy, labor, operational, and market dynamics reveal a complex picture. Hidden layoffs, underemployment, rising costs, supply chain instability, and market volatility exemplify the pressures created by rapid decoupling. Understanding these layers: employment trends, corporate strategy, investor sentiment, and diplomatic maneuvers, is essential to grasp the full scope of the story. What once seemed like a clear and compelling narrative of reclaiming American strength is now complicated by the realities of implementation, market responses, and international interdependence. The Cancel China initiative, although forceful in rhetoric, now faces the challenge of navigating consequences that were underestimated, making the unfolding story more intricate and precarious than originally anticipated. As the Cancel China initiative progresses, the deeper implications for the U.S. economy, workforce, and global trade become increasingly clear. Companies attempting to shift production out of China face a labyrinth of logistical, financial, and regulatory obstacles. Relocating complex manufacturing operations is neither quick nor inexpensive. New facilities must be built or retrofitted, skilled labor recruited and trained, and supply chains rebuilt from scratch. Even with government subsidies and incentives, the time and capital required far exceed initial estimates. Every delay in production or shortage in skilled labor compounds operational risk, slowing product launches and revenue streams. These challenges force businesses to carefully weigh strategic goals against immediate financial realities, often opting for partial or hybrid decoupling rather than full withdrawal. The human dimension of this shift is equally profound. Hidden within otherwise stable unemployment statistics is a growing phenomenon of underemployment and diminished job quality. Workers who lose full-time, skilled roles often move into temporary, part-time, or gig-based work, with lower wages, minimal benefits, and less security. Entire communities that once relied on steady industrial employment are now navigating uncertainty. Reduced spending power affects local businesses, public services, and economic growth. Families face fluctuating incomes that force them to tighten budgets and adjust lifestyles, revealing the real consequences behind headline numbers. These changes also erode public confidence, as the perception of a strong labor market is increasingly disconnected from the lived experience of workers. Technology companies are particularly sensitive to these pressures. U.S. firms rely heavily on Chinese production facilities, rare earth minerals, and access to a massive consumer market. Even minor disruptions, such as regulatory changes, shipping delays, or material shortages, can significantly impact production timelines and financial performance. Investors track these risks closely, often reacting ahead of official announcements, which amplifies stock market volatility. Companies with greater exposure to China experience heightened vulnerability, while smaller firms face even more pronounced operational risks, as supply chain interruptions magnify their financial and strategic fragility. Financial and operational pressures also affect innovation. Decoupling introduces higher costs for materials, logistics, and manufacturing, slowing the pace of technological advancement. Strategic sectors such as semiconductors, renewable energy, artificial intelligence, and advanced electronics depend on global collaboration, combining American research with international manufacturing expertise. Rapid shifts away from established supply chains risk slowing development, delaying product launches, and reducing competitiveness in both domestic and global markets. Consumers ultimately bear the burden through higher prices and fewer choices, illustrating how macroeconomic and geopolitical strategies translate into everyday impacts. Diplomatic and geopolitical tensions exacerbate these challenges. U.S. policies such as tariffs, export controls, and incentives for reshoring are met with Chinese countermeasures, including regulatory interventions, supply restrictions, and control over critical resources like rare earth minerals and advanced components. Multinational corporations must adopt hybrid strategies to mitigate risk, diversifying suppliers or partially relocating production while maintaining some operations in China. Yet complete insulation from geopolitical risk is impossible, as even minor policy shifts in Washington or Beijing can instantly affect global operations. These interactions highlight the interconnectedness of global trade and the complexity of navigating decoupling strategies. Investor scrutiny intensifies as financial markets react to these uncertainties. Analysts examine revenue exposure, supplier dependencies, and vulnerability to policy changes. Market movements often anticipate official announcements, reflecting investor concerns about supply chain disruptions and profit risks. Companies heavily reliant on Chinese production or consumer markets experience the largest swings in stock valuations, highlighting the systemic risk introduced by aggressive decoupling. Even firms taking careful, partial steps away from China face volatility, demonstrating that uncertainty alone can ripple across industries and markets. Domestically, unintended consequences continue to emerge. While the initiative seeks to restore American manufacturing dominance, relocation costs, workforce training, and infrastructure development slow progress. Many firms adopt cautious approaches, balancing decoupling with financial and operational realities. Innovation suffers as global collaboration is disrupted. Projects in semiconductors, artificial intelligence, renewable energy, and other strategic sectors face delays. The ecosystems that enable rapid technological progress cannot be replaced overnight, and attempts to accelerate reshoring often generate high costs and uncertainty. Consumers are also affected. Supply chain disruptions result in delayed product launches, limited availability, and higher prices for everyday goods. Electronics, medical equipment, vehicles, and household items illustrate the broader impact of trade and technology policies. Businesses, schools, and government agencies reliant on timely access to these goods are equally affected, showing how these economic shifts permeate daily life. Higher costs and restricted choices also influence demand patterns, further complicating recovery and adaptation efforts. Global consequences are significant as well. Economies in Europe, Asia, and developing countries feel the ripple effects of U.S.-China tensions. Factory slowdowns, supply chain interruptions, and inflationary pressures create uncertainty across sectors. Investors track these developments, recognizing that disruptions in one major economy propagate globally. Aggressive policy measures or sudden shifts in trade strategy carry systemic risks that extend far beyond the bilateral U.S.-China relationship. The interdependence of modern economies makes rapid decoupling a highly complex and risky endeavor. The cumulative effects of operational challenges, market volatility, labor shifts, and geopolitical uncertainty reveal the intricate dynamics of the cancel China strategy. Hidden layoffs, underemployment, rising costs, disrupted innovation, and market fluctuations demonstrate how interconnected decisions are across industries and nations. By examining these layers, workforce trends, corporate strategy, investor behavior, and international relations, it becomes clear why the seemingly powerful narrative of reclaiming American strength is now challenged by real-world complexities. The initiative, while forceful in rhetoric, faces pressures that were underestimated, and its long-term impact remains uncertain as the U.S. navigates the precarious balance of economic ambition, global interdependence, and domestic stability. As the cancel China strategy continues to unfold, the full picture of its consequences becomes increasingly visible. The initial narrative promised job growth, strengthened domestic manufacturing, and technological independence, but the reality is far more nuanced. Companies face enormous costs and logistical hurdles in relocating operations, while workers experience underemployment, wage pressure, and reduced job security. Communities that once thrived on industrial jobs now face economic uncertainty, revealing a disconnect between headline labor statistics and lived experiences. These hidden dynamics illustrate how policy intentions can diverge dramatically from outcomes when global interdependencies are involved. Technology companies remain at the center of the storm. Heavy reliance on Chinese production, materials, and consumers means that even minor disruptions have outsized effects. Stock markets react swiftly to political signals, regulatory changes, or export restrictions, amplifying volatility. Startups and smaller firms are particularly exposed, as any supply chain disruption can jeopardize survival. Innovation also suffers. Global collaboration between American research and Asian manufacturing expertise underpins strategic sectors like semiconductors, AI, renewable energy, and electric vehicles. Rapid decoupling disrupts these networks, delaying product launches, slowing technological progress, and increasing costs for both producers and consumers. Geopolitical tensions further complicate the landscape. U.S. tariffs, export restrictions, and reshoring incentives are met with Chinese countermeasures, including control over critical resources and tighter regulations on foreign companies. Companies respond with hybrid strategies, partial relocation, diversified suppliers, and cautious investments, yet no approach fully shields them from risk. Investors scrutinize every signal, from production delays to policy announcements, creating a feedback loop where perception alone can move markets. The intertwining of economic strategy, politics, and global diplomacy underscores the difficulty of implementing rapid decoupling without unintended consequences. Financial pressures ripple through everyday life. Supply chain disruptions and rising production costs translate directly into higher prices for electronics, vehicles, medical equipment, and household goods. Families feel the impact through increased expenses and limited product availability, while businesses and institutions face operational challenges. Labor markets mirror these stresses. Job quality erodes even if unemployment remains low, with more workers taking part-time, gig, or lower-wage roles. This combination of factors creates a subtle but significant strain on the economy that often goes unnoticed in broad statistics. Globally, the effects extend far beyond the United States. Europe, Asia, and developing countries experience factory slowdowns, inflationary pressures, and disrupted trade flows. Investors and multinational corporations track these developments closely, understanding that shocks in one major economy propagate worldwide. Rapid or aggressive decoupling carries systemic risks, affecting markets, production timelines, and international relations. The interdependent nature of modern trade means that the initiative's repercussions are not confined to domestic politics, they reverberate across continents and sectors. Ultimately, the Cancelled China initiative demonstrates the complexity of translating policy rhetoric into practical results. While the stated goal was to reclaim American manufacturing strength and secure technological leadership, real-world obstacles, financial, operational, labor-related, and geopolitical, have slowed progress and introduced unforeseen risks. Hidden layoffs, underemployment, supply chain vulnerabilities, market volatility, and slowed innovation all illustrate the challenge of achieving these objectives in a globally connected economy. As the coming months unfold, observers will see whether the United States doubles down, adapts its approach, or shifts strategy entirely. Meanwhile, China's responses through trade policies, resource control, and regulatory measures will continue to shape outcomes. Investors, policymakers, and the public alike must watch closely to anticipate risks and understand the full impact of these complex interactions. The story of Cancelled China is far from over. It is a lesson in how interconnected economies magnify the consequences of bold policy moves, affecting workers, consumers, markets, and the global balance of trade in ways that are only now becoming fully apparent. By tracking labor trends, corporate decisions, investor behavior, and diplomatic developments, the larger picture emerges. A narrative once presented as straightforward now reveals a web of unintended consequences and systemic pressures. Understanding this layered reality is essential for comprehending the true stakes of the Cancelled China initiative, its ongoing challenges, and the unpredictable outcomes that lie ahead for the U.S. economy, its workforce, and global markets.